Good afternoon, everyone. This is Mazen Al Saderi from Al Rajhi Capital. Al Rajhi Capital is pleased to host Arabian Drilling Q1 2024 earning call. Welcome all to the call. And now I will hand over the microphone to Mr. Ghassan, the CEO of the company. Please.
Good afternoon, everyone, and welcome to Arabian Drilling's earnings call for the first quarter of 2024. Our thanks to Al Rajhi Capital for hosting this call. We announced our financial results yesterday, and the documents are available on our investor relations website. As usual, we must start with a disclaimer, so I invite you to read it at your convenience. Let me now introduce our speakers for today's call. First, we will get a performance overview from our CEO, Mr. Ghassan Mirdad. Then our CFO, Mr. Hubert Lafoy, will take us through the financial performance. The agenda for today's session will cover various topics, including key milestones, a review of our operational and financial performance, and forward-looking guidance. We will then open the floor for your questions. I would like now to hand over to our CEO, Mr. Ghassan Mirdad.
Thank you for the introduction, Raed. Assalamu alaikum and heartfelt welcome to all participants joining us for this earnings call. We will begin with a brief overview of this excellent quarter. Q1 2024 was a strong start of the year, with an excellent operational execution, solid financials, and achievements to celebrate. Starting with operation, we have maintained our utilization rate of 69%, with 47 active rigs over a total available fleet of 49, same as last quarter. Our non-productive time of 0.81% was the lowest achieved over the last 4 quarters. Our 36-month rig efficiency index was consistently strong at 94%. Over the quarter, we added 56 additional drilling days through our rig move efficiency, which all added directly to the bottom line. On the health, safety, and sustainability front, we improved our total recordable injury frequency rate, and we were very pleased to receive Aramco Award for the best HSE Health, Safety and Environment Offshore Rig of the Year, as a testimony to our safety culture. On the sustainability front, we finalized our Scope 1 and 2 baseline emission to progress on our long-term sustainability efforts. This is an important step that will let us measure the effectiveness of our strategy, and we look forward to publishing our sustainability report by the end of this month. Moving to the financials highlights, which Hubert will cover later in more details. Compared to Q1 last year, both our revenue and EBITDA showed strong growth of 24% and 25% respectively. Our EBITDA level was 42% this quarter, which is in line with our expectations and market consensus when normalized. On the growth front, we have great news. On the unconventional rigs, we are very pleased to announce that we started drilling operation last week on the first of our unconventional rigs, ahead of schedule. This early start would not have been possible without the support of our partners, Aramco. And we look forward to continue working closely with them on this exciting project. For this rig alone, we will account for an additional 6 weeks of drilling revenue ahead of plan. We expect another few rigs to start before the end of H1, which will give us some more revenue upside. Let's now have a look at the latest contract and rig activity updates. On the land rig activity side, as mentioned, we started our first unconventional rig and the startup activity for the other 9 rigs are in full swing. I would like to recognize the team who is doing an excellent job in getting those rigs ready to drill quicker than initially planned. Also, this quarter, on the land rig activity, we started an idle land rig with our customer KGO, Kuwait Joint Operation. This is a new milestone as we never had a land drilling operation with KGO in the past. On the other hand, one land rig finished its lump sum turnkey contract, and we expect to reassign it to another customer shortly. The previously announced suspension of the 3 offshore rigs will be effective towards the end of Q2. We are having constructive discussions with Aramco to achieve the best possible outcome for all parties. As mentioned in our earnings announcement, we are finalizing the terms of the suspension. From a market outlook standpoint, we see further growth opportunities in the conventional and unconventional gas drilling space in Saudi Arabia. Let's now discuss our backlog. The backlog of 11.8 billion was mostly stable compared to last quarter. Our quarterly backlog naturally consumption rate was mostly affected by the addition of the 3 unconventional rigs contract award. The backlog reduced by 900 million due to revenue recognition during the quarter, offset by the 800 million coming from the 3 new unconventional rig contracts. We have 7 rigs rolling off contract in 2024, of which 3 are offshore and 4 are land. All 3 offshore rigs are under negotiation, and the 4 land rigs are expected to be extended or reassigned to a new project. Moving on to the next slide, we have a strong start of the year operationally. Looking at the top left, we kept the Aramco Rig Efficiency Index at a very high level of 94% in Q1. Then, more importantly, as you can see in the green, over 90% of our rigs are scoring in the high and superior performance category, which is the highest score achieved in the last 4 quarters. On the lower left graph, you can see that our quarterly non-productive time dropped further to 0.84%, which was the lowest achieved over the last 4 quarters. Overall, we see a very good trend over the last 4 quarters, with the 12-month rolling average heading in the right direction. On the top right, our rig move performance was also consistently strong, with an average of 1.3 days saved per rig move. If you multiply 1.3 days saved per rig move by the number of rig moves completed, we have effectively gained an additional 56 drilling days in Q1. If you recall, in Q1 last year, we did not save any day from the rig move due to bad weather. Even though we experienced worse weather conditions this quarter, the performance of our offsite team enabled us to operate as normal. This is another proof of the benefit of continuous enhancement we are implementing. With that, I will now hand over to Uber to go through the financial performance. Uber?
Thank you, Ghassan, and good afternoon to everyone on the call. First, let's have a look at some of the key numbers for the quarter. Financially, we also had a strong start of the year with our quarterly numbers. We closed with revenue of 967 million, showing a 24% year-on-year increase. Our EBITDA was 405 million, representing a 42% margin and in line with our expectation. The CapEx spending for the quarter was north of 300 million, of which approximately 2/3 related to the ongoing CapEx program of the unconventional rigs. Our free cash flow remains negative as we're in full swing with our ongoing CapEx growth. We're showing a return on equity of 10% based on our last 12 months net income over an equity position of 6.1 billion. We closed the quarter with a net debt of 1.85 billion and a leverage ratio of 1.2 multiple, which is stable compared to what we had in the last quarter. Now, let's go a little bit more in detail and let's have a side-by-side comparison year-on-year and quarter-on-quarter. So first, I'm going to look at the year-on-year Q1 24 versus Q1 23, which is on the upper graph. And I'm going to go from the left-hand side to the right-hand side. So we start with the revenue first. So looking at the revenue, we have a strong year-on-year increase of 24% from 779 million to 967 million, mainly coming from the additional 3 jack-up that started mid-year 23. Then moving along on the right, following the revenue upside, EBITDA also increased by 25% year-on-year from 323 million to 405 million, mainly coming from the contribution of the 3 offshore rig, as mentioned. The EBITDA increase of 82 million SAR was partially offset in Q1 24 by the impact of unconventional startup cost of 26 million. If you exclude the startup cost and normalize Q1 24 EBITDA, we would be approximately at 430 million of EBITDA. Net income shows a much reduced growth of 3% from 141 to 146 million. Q1 24 net income was impacted by increased interest expenses as well as additional depreciation costs compared to Q1 of last year. And then again, there is also the impact of the 26 million startup weighting down. Again, if we were to normalize net income and exclude the startup cost, net income would be north of 170 million for this quarter. Just a note on the increased interest and depreciation expenses affecting Q1 24 net income. The increased interest expense year-on-year comes from the combined effect of increasing the debt position, higher market interest rates, as well as a portion of the interest expense that were capitalized in 23. For instance, in Q1 23, we capitalized 18 million of interest expenses related to the offshore fleet expansion program, the one that took place last year. The increased depreciation expense year-on-year is mainly coming from the full impact of the 3 jack-up, as well as some well-controlled equipment purchase and upgrade, which took place last year. On the CapEx side, on the year-on-year number does not really compare since Q1 23 did not include any of the unconventional CapEx program. However, in Q1 23, we incurred some CapEx related to the shipyard activities for the 3 jack-up contract preparation. Now, moving on to the quarter-on-quarter, Q1 24 versus Q4 23 comparison, which is shown on the bottom graph, and again, going from left to right. The revenue was slightly lower by 20 million, with a number of factors offsetting each other, including 1 less operating days in Q1, with the month of February being shorter, and also high rig move activity witnessed in Q4. From an EBITDA standpoint, we have a 30 million decrease from 435 million to 405 million. So 20 million of that is coming from the revenue decrease, as I just mentioned, and the remaining 10 million is coming from additional unconventional startup incurred in Q1, as well as some year-end adjustment numbers. Now, if you look at the net income, you will see that there is a decrease of 37 million from 183 to 146 million. So again, 30 million can be explained as coming from the EBITDA, as I have just described. And there is an additional 7 million, mainly related to an increase in the Zakat taxable base, as well as deferred tax liabilities generated by capitalizing equipment and assets in our books. If you now look at the CapEx, you will see a decrease of 43% between this quarter and the last quarter, from 535 to 306 million. This decrease is coming from 2 things. First, we spend approximately 75 million less in Q1 on the unconventional rig CapEx program. And in Q4, we also had significant CapEx spending coming from the purchase and upgrades of well-controlled equipment. Overall, on the 10 unconventional rig CapEx program, we have spent close to 800 million to date, and we estimate that the total program is around 1.75 billion. If you add the additional 3 rigs that were recently awarded, then the total estimated spend for all 13 rigs award is expected to be in the range of 2.2 to 2.3 billion. We expect to see a bit of an acceleration of the CapEx spending in the second quarter as we now take physical delivery of some of the unconventional rigs, which is going to trigger further milestone payments. On the next slide, which is a segmental reporting, we are breaking down into the 2 different segments. So you have the offshore segment and the land segment. And then within the segment, we are looking at 2 things, the revenue and the gross profits. As a reminder, the gross profits includes direct operating costs of the rig, as well as the depreciation expense, but does not include G&A, nor interest, nor tax. For the offshore segment, as mentioned by Ghassan, let's reiterate the fact that the full offshore fleet was 100% operational during the quarter. So if you look at the top left graph, offshore year-on-year Q1 24 versus Q1 23 does not really compare. In Q1 24, we have the benefit of the full impact of the 3 jackups that were added in Q3 of last year. Also, in Q1 23, the offshore utilization was slightly lower due to one of our offshore rigs being in shipyards for most of the quarter for a planned mandatory recertification. Compared to the prior quarter, which is the upper right graph, on the same rig activity level, the revenue was flat and the upside on the gross profit was mainly due to lower staff compensation cost. Now let's have a look at the land segment, which is the bottom graph. And first, at the year-on-year comparison, Q1 24 versus Q1 23 on the lower left side. So for the land segments, the revenue increased by 7% from 480 million to 514 million with the same level of rig activity. The increase that we see in Q1 24 is due to the fact that we experienced last quarter a high activity of planned maintenance with a few rigs being on 0 rates. And also we had a better rig move performance this quarter compared to last quarter, as Ghassan just mentioned. Still comparing year on year, we can see that the gross profit in Q1 24 is slightly below that of Q1 23, in spite of the increase of the revenue. And again, this is mainly due to the unconventional rig startup cost that impacted Q1 24 profitability with an additional 26 million of expenses. Now, looking at the quarter-on-quarter comparison, which is the bottom right graph, on the revenue for the land segment, we are losing 25 million from 539 to 514 million, which is a 5% decrease. As you may recall, Q4 23 land revenue was the best quarter on record due to a very high rig move activity. On the gross profit, we lose 20 million from 79 to 59 million, which is a result of the 25 million revenue difference, as just mentioned. The next slide is a cash flow bridge that provides a snapshot of the cash movement for the quarter. Overall, we started the quarter with a cash position of 1.4 billion, to which we added 405 million of EBITDA contribution, offset by 306 million of capex, again, 2/3 relating to the unconventional. We also had some financial obligation of 41 million, which include a loan repayment of 25 million, with the rest being lease obligations. In the quarter, we repaid interest expense of 86 million net, which include the semi-annual Sukuk coupon payments of 78 million that took place in February. We did not withdraw any further financing line during the quarter. Finally, we had a swing on the net working capital, mainly due to the increase of inventory as we are starting up the unconventional rig, as well as significant trade payable settlements made during the quarter. Overall, we closed with a cash position of almost 1.26 billion, of which we invested on average 800 million in short-term deposits as a natural offset to the cost of servicing the debt. Moving on to the detail of our debt profile. Our gross debt position remained roughly the same during the quarter. We have a total borrowing of 3 billion, made up of 2 billion sukuk and 2 bank loans of 500 million each. We started repaying one of the bank loans with a payment schedule of 25 million per quarter. The repayment schedule of the second bank loan will start in 2025 with an additional 25 million principal repayment per quarter. Quarter on quarter, the company net debt position of 1.85 billion has increased by approximately 100 million or 5%. However, our net debt to EBITDA leverage ratio has remained stable as 1.2 multiple on the account of a growing EBITDA number. Going forward, we may decide to draw on additional debts to finance the remaining 3 unconventional rigs, and we already have a bank facility secured at a very competitive price. My last slide relates to the 24 guidance. At this point in time, we reiterate our revenue guidance for full year 24, with the revenue expected to be in the range of 3.6 to 3.9 billion. The guidance factors the upcoming suspension of the 3 offshore rigs. We also reiterate our CapEx guidance with the expected spending to be in the range of 2.1 to 2.4 billion as we continue to invest in the unconventional CapEx program. This concludes my section, and I will now hand it back over to Ghassan for his closing remarks.
Thank you, Hubert. In closing today's presentation, we have had a strong start of the year operationally and financially, building on the excellent progress we are making across the organization. We always expected that the offshore market might soften by 2027. Accordingly, our growth strategy included some buffer that materialized with the leasing of 2 rigs that we believe would have been released at the end of their contract. Our client discussion accelerated the process of adjusting our fleet deployment, and we have taken the time to evaluate our options. These include keeping our rigs and releasing the leased ones, or keeping the leased rigs and deploying our own rigs in a new market, or a combination of both. We are nearing finalization of the suspension, which at the point will not impact our guidance, as mentioned by Hubert. Our segment mix will evolve as a result, and the growing land contribution will bring long-term stability in the sector that is crucial for Saudi energy transition. We believe that gas will continue to grow both on the unconventional and conventional front. 2024 will mark the peak of our current investment cycle, and we are delighted with the early start of our first unconventional rig. Our team are focused on delivering all 10 rigs ahead of our internal timetable to see the benefit of the new revenue stream flowing through. As mentioned at year end, we are set to deliver continuous top-line growth for the full year. I will now hand it over back to Raed Al Rajhi Capital for the question and answer session.
Hassan, thank you, Hubert. Now we'll start the Q&A, and we'll start with Ricardo. Ricardo, please, can you mention your company and before your question? Thank you.
Resende with Morgan Stanley. Thanks for taking my question. I guess first question, just following up with something that Ghassan mentioned about the suspension on the rigs and some of the choices that what you might do with your own lease, your own and the lease rigs. Ghassan, you mentioned potentially deploying your own rigs in other markets. Could you please just remind us what's the latest status on having all the approvals and qualifications to bid in other markets? I'm just trying to get a sense on the timeline on how long could it take to deploy the rigs eventually in another market. And then the second question, it's on the unconventional gas in Saudi. You've been very successful on deploying your first rig ahead of the schedule and being able to book extra revenues because of that. And how sustainable was this deployment ahead of schedule? Meaning, could we expect the same to happen in other rigs as well, or was that more of a one-off? Thank you.
Okay, so a very good question on the qualification. We are in the final stages of qualifying for KOC for offshore. However, you know, with the offshore rigs, there is different means of penetrating a market. You can work, you can you know, lease the rig. You can work with a local supplier in another environment, another geography. So there is different ways other than going direct straight. And this is what's going to make it easier for us if we want to deploy into different markets in terms of the offshore. In terms of the unconventional, I mean, I think the investment that we put in place and all the recruiting that we hired ahead of time is paying off, and we've seen the first rig, and I believe we are seeing more rigs coming ahead of time. So in our initial, we expected H2 to start flowing of revenue, and now we'll see more than one rig that will start flowing revenue before the end of H1.
Ricardo, any further question? Okay, I'll move now to Ibrahim. Ibrahim, now you are unmuted, and please mention your company.
From Ashmore Investment. Congrats on your earnings during Q1 2024. Do have a couple of questions from my side. One is on the guidance. Can you elaborate more on what kept, or what's the reason behind keeping the revenue guidance at the same level? So just quick calculation, if we analyzed Q1 revenue, it will come up around 3.9 billion. So were you conservative from the beginning in your guidance for 2024? And what are the other reasons?
I mean, I think we just factored, you know, we factored that there may be a drop on the offshore rigs because the announcement of Aramco, and I think our factors were good, so that's why we're not impacting our guidance right now. Anything you want to add?
No, that's it. I mean, I think the guidance that we gave, I mean, we already cooked into the guidance the fact that we'll see a suspension. And then the guidance was based on what rigs and what timing, etc. But at this point in time, you know, we're not moving the guidance. So it's already taking into account that 3 offshore rigs will be suspended.
When you provided the guidance revenue of 3.6 to 3.9, do you believe that earnings or EBITDA will be lower than initially anticipated when you built the guidance at the beginning?
So we haven't given any particular guidance on the EBITDA. We've communicated on a number of times that, you know, the EBITDA would be in the range of the low to mid 40s percentage points. We're not, you know, we believe that there will be a slight erosion because obviously, you know, the suspension will be effective. It's going to happen within the next 45 days, and 3 rigs is going to be suspended. So there will be a slight erosion of the EBITDA, and you know, we're probably going to move from low to mid 40s to low 40s.
Excellent, thank you, Hubert. Second question from my side is, I would really love to hear your view on the market right now post the suspension of 20 or 22 rigs of the offshore market, of course.
So
what would be the impact? How fast will be redeployed? Any medium-term impact on day rate, etc.?
No, so I think it's if you want to penetrate a new geography that you want to be, I would say, qualified, this will take time. So you need to work with what you have and see how you can deploy faster, and that is either by bareboat charter or working with a local contractor who's actually approved as in that geography. And this is what we kind of be a bit creative and think out of the box and how you can deploy. But that is one option, right? You have 3 options. One option is, we just release the released rigs, or we keep the leased rigs and try to deploy our rigs, or it can be a combination.
Excellent. And if I may, one last question from my side. So during the last 2 years, we've been seeing cost push in the offshore market specifically because of how tight the market is. And this led to retention program for your employees, higher costs, etc. Post the release of these rigs right now by Aramco, do you expect some relief on the cost structure?
Yes, you're spot on.
Can you quantify the numbers?
I don't have it on top of my head.
So look, I mean, we're reviewing, we're assessing the numbers, but there is definitely an expectation that the cost of the retention is going to go down. We're still discussing finalizing the terms of how we will effectively implement that. At this point in time, it will be a couple of it will be. I mean, it will be. I'm not going to say it's going to be material, but there's going to be some. This is something that we're factoring into our numbers as we go through 2024.
Excellent. Thank you, but thank you, Ghassan. Wish you the best of luck.
Thank you.
Thanks a lot, Ibrahim. Now we're going to go to Akrash. Akrash, please mention your company.
Congratulations on the results. I have two questions. First one is, you mentioned you have 4 offshore rigs.
Akrash, please mention your company.
Yeah, it's SECO Bahrain, Securities and Investment Company Bahrain. Yes. So I have 2 questions. First is, you mentioned that 4 offshore rigs will be rolling off next year. So what is the plan there? How do you see that going? And just one clarification. You said 3 offshore rigs are rolling off this year. So these are different from the suspended one, or are these the same as the suspended ones? This is the first question. And second is, what is the plan turnaround for this year? Or any that you have built in?
Yeah. So the three that's gonna offshore that's gonna go this year, or are they under renewal this year? It's all under negotiation. But you have to understand, not all of them were Aramco. So 2 of them were with KGO. So we are in the finalization of the negotiation. Two of them, and we're in of the 3 rigs that is going to be suspended. So it's combination. Is that the question about, right? The first 3 rigs.
Yes,
what was the second question?
Yes.
What's the second question?
The
second question?
Turnaround. Do you have any maintenance turnaround expected this year?
Maintenance turnaround.
Sorry, what do you mean exactly?
So your planned turnaround for rigs, any shutdowns that you might have for rigs, any maintenance activity that is required?
I think what we have been doing, what we've been doing, and correct me if I'm wrong, Uber, we're being very efficient to do, instead of having a full shutdown, if you need to do a major recertification, you have to kind of stop the rig, which I think most of the rigs that we're going to have now is mainly doing the maintenance as we move from well site to the other site. You do the maintenance and try to complete it without having a big impact on stopping the rig.
Yeah.
Right.
And we also wait for the outcome of the suspension to see, because this has an impact as well on the timing of the maintenance.
Yeah.
Okay, thank you for your answers. All the best.
Okay, thank you, Akrash. Oliver, you're unmuted, and please mention your company.
Two from my side. First one, just I guess following up on Akash's question around the contracts rolling off next year. You have 4 expiring. Any thoughts on sort of Aramco's appetite for renewing those? And And then secondly, on new markets, whether it's for the suspended ones or if you have any other contracts rolling off in the medium term, if you enter with another company, another contractor, local supplier, is there any sort of changes to realized margins by doing that instead of being able to go in directly under pre-qualification? Thanks.
So if I understand, you understand, I couldn't hear the question very well.
No, on the new markets, can you repeat the question?
Yeah, the new markets one was, you were just making the point that you could enter with local contractors. I was just trying to understand what kind of margins you'd expect by doing that instead of obviously going in directly if you were qualified.
Yeah, I mean, it will not be the same margins, yes, but you'll have your assets working. And it's very early. It's not, not in our guidance yet, because this is something that, was not planned for. So it's not in our numbers yet.
No.
It's very, very, very difficult to say now, because you just have to finalize the agreement. If we're going to go with another company, we just have to finalize the agreements and how we can move forward.
Let me come back maybe on the first question, which is the contract rolling off. So we have 4 rigs rolling off contract in 2024, 4 offshore rigs. All of them are with Aramco. So we have two rigs that are owned, and then we have the 2 lease rigs that are rolling off contract at the end of 2025. So the question is whether they're going to be extended or not. First we have to come out and see what rigs are going to be suspended and how this affects the timing of the rig rolling off contract.
Can you mute your lines, please? Yeah, and let me add to Stefan, to Uber, is if we go with another geography, and there is different ways of leasing. We can dry lease, so you just lease at just the rig, and there is another type of lease where you lease the rig with the crew, so it's a different calculation. So and there is some leases you run the whole operation, but it's under another contractor name, another contractor name who works locally. So there's different methods of looking at it.
Hi, Oliver.
Just wanted to be clear that is one option of the 3 options. So there is one option that we return the leased rigs. Second option, we keep the leased rigs and deploy our rigs. And the third option is a combination of both. So just wanted to make sure that everybody's clear. Fadal Mazen.
No, Oliver, are you done?
Yeah, sorry, I was still on mute. Yes, thank you. That's very clear.
Thanks. Great.
You're welcome.
Okay, I have a question, Ghassan and Uber. What is the possible scenarios or the most possible scenarios for those 3 rigs? And because there is a question from Rohana Ahmed, one of the analysts in the chatting box, is asking, what is the payment that Aramco that will pay as a termination payment to Arabian Drilling? So what are the scenarios and what is the termination payment you might receive?
So if you look at the most of the rigs that we have in Aramco, if they pass their initial term of contract, the termination clause is not there anymore. So when we try to choose from the rigs, we need to look at what works for Aramco, and we're working together as one team to see how to have a better output for both parties. So let's say, for example, Aramco most probably will choose a rig that doesn't have we call it an ETF,
an early
termination fee.
Okay, what is the possible scenarios? The most possible scenarios?
What do you mean? What's most possible scenario?
Possible, that might is more to cancellation or delay or suspended for a year.
No. So it's clear Aramco is suspending; they're not canceling. However, when they suspend, what happens is you keep the contract. So the suspension is for 1 year. you keep the contract, and then after 1 year, we see how we can deploy it again with Aramco. However, Aramco is giving us the kind of freedom. If we see that there is a need that we can deploy the rig somewhere else, they're open up with us how we can, cancel the contract and deploy it somewhere else. Of course, keeping in mind that, our client Aramco doesn't get impact financially, of course.
Yeah. So just to be clear, during the suspension of contract means that there is no early termination fee because the contract is not cancelled.
Clear, very clear. Thank you. Now, Gerard, you want to ask? You're unmuted, please.
Thanks for letting me ask a question. So just on the dividend, how can investors think about the dividend for this year and next year? And if the 80% payout ratio has fallen away, will it come back at some point in time?
Well, I mean, we're just, what we're trying to do our best is, we're in a very growth cycle right now, and we just have to go with the board and the shareholders at the end on the dividends on a quarterly basis to see how we're going. Sorry, in a half year basis, biannual.
I mean, it's just the same. It's just the same thing, right? I mean, every half year we're assessing, we're trying to balance out returning shareholders' value with the capex need, with the management, the need of cash, etc. So at the end of the day, we look at, every 6 months we look at where we are, and then the board makes the judgment call and makes the final decision.
Yeah.
And so it's not going to be any different this time than it was last year.
Okay, got it. Thank you.
A question from the chat box. Can you provide a broad breakup between the cost of goods sold and the OPEX of the startup cost of the 26 million related to the unconventional rigs?
So the 26, not sure I got, so the breakdown of the 26 million?
Yes.
Okay, so look, I mean, the 26 million is purely, it's mostly compensation cost, right? Because what happened is that, and this is one thing that Ghassan highlighted, which I think it's important for everyone to understand. I mean, this investment upfront of securing the crew, training the crew, having them ready so that day one we can deploy the rig as quickly as possible is part of this investment. So the 26 million is purely compensation cost, which is basically securing the crew ahead of deploying the rig.
So just to kind of put some flavor onto this, our crew, they work 1 month on, 1 month off. So if you want the crew to work for 3 months between getting up to speed, knowing the client, being part of the building the rig and seeing the rig while it's constructed and part of the deployment, let's say it takes 3 months. But that means you need them 6 months before, because there is, for every month they're on, there is 1 month off. And that's why you see the high level of investment that you do. But, I am very, very proud of the team. With the investment we've done, we're seeing the rigs are really literally, coming very faster than we expected.
Thanks.
But as mentioned by Uber, it's a compensation cost.
It's compensation.
Yeah.
Okay, other question from the chat box. Is the company considering to participate in tendering from Kuwait Oil Company?
So good question. So there was a tender that came out. However, we want to play. So in Kuwait, you have different markets. You have the high-end market, which we want to play in. The tender came out early in the year, and by the time we got approved was literally at the submission date. We tried to extend the submission. Unfortunately, they could not, because they already extended it more than once. Now the tender that is out right now is for the low tier. So the returns will not be as as we would like to have. So we're not participating in the tender with the low tier rigs.
Many thanks. I think Ibrahim, are you raising your hand? Okay, any further question?
No, thank you. Nothing from my side. Thank you.
Yeah, hello, Ibrahim. Any further question, please? Want to ask, could raise his hand. Thanks.
I think if there's no questions, you want me to close, Mazen?
No, we have one more question in the chat box.
Okay.
Are you planning to participate in a future unconventional tendering? How many unconventional rigs are you targeting in that segment by 2030?
So, I mean, we will see both in conventional and unconventional. It is very known by everyone today. The country is focused, a lot of focus is in the gas. We already been in touch by, different clients that they want us to add more rigs in the gas from the LSTK point of view. But even Aramco is, focusing more on gas. And we will expect to see some tenders both in unconventional and conventional as well. And, as the tenders come, we will participate, of course. Now, on the unconventional, we expected that they're going to go up to 60 rigs. This is, to be honest, still the plan. However, my own opinion, with the success that Aramco has in the unconventional, I mean, I would say hat down to them on the success and the production that they're getting. So I don't know if the tendering cycle will be the same or it will be a bit delayed, because they're having excellent output of what they're doing right now. And adding our third, the tender that they had today, I think they will be in a very, very good position. So I'm not sure if they're going to continue tendering for the unconventional as they planned initially or not.
And there is one more question in the chat box. In case contract cancelled by Aramco, what is the amount of termination fee? From Wazal Zaman.
Yeah. So as mentioned, the contract is not cancelled, is suspended. So no, there is no impact on Aramco as we speak right now.
So early to talk, you want to say about cancelling. We should talk more about suspending. Anyway, any further question? Please raise your hand. Well, looks that there is no further question, Mr. Ghassan and Hubert. Many thanks for your comprehensive and transparency.
Thank you, Mazen. If you allow me just to highlight, so, we know the 3 offshore rigs are, happening. We're just firming it up and closing it. Revenue guidance is not affected. We are extremely excited with the achievement of starting the first rig and the flow of the other rigs that are going to come. We're going to see an acceleration of revenue coming from the unconventional. I just came this morning from, a meeting with Aramco team, technical team. They're extremely happy and excited from the day we were awarded till today. They see an excellent performance. So we're very, very excited. Thank you very much. And I look forward to seeing you next quarter with good news as well. Thank you.
Thanks a lot. Thank you all.
Assalamu alaikum. Thank you.